And welcome, Mansoor Sharif here with another important international accounting standard, IFRS 16. It's one of the most complex standards because it deals with future and involves uncertainties. Let's try to understand IFRS 17 with basics. IFRS 17 is the accounting standard that deals specifically with insurance contracts. This standard applies to insurance companies that prepare their financial statements under IFRS. One very important thing to understand is that IFRS 17 introduces one single accounting model for all insurance contracts. This is a major change because earlier different companies followed different methods. IFRS 17 completely replaced IFRS 4, and because of this change, it is extremely important for professional exams like ACCA, CA. Let's try to understand what is an insurance contract. It is a contract under which one party, the insurer, accepts significant insurance risk from another party, the policyholder, by agreeing to compensate the policyholder if a specified certain future events, insured event, adversely affect the policyholder. We have tried to explain this through this diagrammatic example. Here the insurer and the policyholder, they are signing the contract. Is this one the insurer? Here we have he has a significant insurance risk. The policyholder will compensate uh, if the contract was insured event, if the event which they face was an insured event. Next, let's try to understand why IFRS 17 was introduced. To understand IFRS 17 properly, we first need to understand the problem of the previous standard IFRS 4. Under IFRS 4, insurance companies were allowed to use their own accounting policies. This meant two companies with similar insurance contract could show very different profits. In many cases, profits were recognized too early, even though the insurance service had not yet been provided. Also, insurance liabilities were not measured consistently. IFRS 17 was introduced to remove these weaknesses and bring consistency, comparability, and transparency in financial statements. It's important to remember that IFRS 17 isn't just for insurance companies, it is for an insurance contract. It is effective from the date 1st January 2023. IFRS 17 is effective from that onward. Next, we have the objectives of IFRS 17. The objective of IFRS 17 is very important for exams and for students who are having their professional degrees. The main objective is to faithfully represent insurance contract in their financial statement. This means insurance liabilities must be shown realistically and profit must not be recognized on day one. Instead, profit should only be recognized when the insurance service is actually provided over the time. Next, we have the scope of IFRS uh, 17. Which things are under the scope of IFRS 15 and what are exempts from this IFRS. Uh, let's look at the scope of IFRS 17. This standard applies to insurance contract issued by insurers. It also applies to reinsurance contract held by the insurers and to some investment contract that contain insurance features. The key condition is the existence of insurance risk. If insurance risk exists, IFRS 17 normally applies to these kind of contracts. Next, we have out of scope items. Not all contracts are covered by this IFRS 17. For example, product warranties issued by manufacturers Employee benefit plans and financial instruments like derivatives are excluded from this IFRS. These are covered by other IFRS standards. In exams, students, you are often tested on whether a contract is inside or outside the scope of IFRS 17. This is an important one for students who are appearing for exams. Next, we have the key terminologies under this IFRS. We will try to understand these definitions which are critical to understand this IFRS. An insurance contract is a contract where one party accepts insurance risk from another party. Insurance risk exists only when there is an uncertainty about future payment. Fulfillment cash flows represent the expected future cash inflows and outflows needed to fulfill the insurance contract. Risk adjustment represent compensation for uncertainty in those cash flows. Next, we have core requirements of IFRS 17. Insurance contracts must be measured using current estimates, not old assumptions. Profit must be separated from the insurance service, which means no profit is allowed at the initial recognition. Professional judgment is required, especially when estimating future claims and expense, and assumption must be reviewed on a regular basis. What is the initial recognition criteria? We will try to understand through this slide. Here, the initial recognition criteria is it shall be recognized at the earliest of these three: beginning of the contract period during which contracts insurance services are provided; second, date when the first payment from the policyholder becomes due; third, for the group of owners contract when the group become onerous, means they are making loss at that time. The earliest of all these three, then we will recognize it as a contract. The initial recognition criteria is the earliest of these three. Next, we have the measurement criteria of this IFRS. We have normally two main criteria, two models. First is the general model, second is the simplified model. In general model, here we will apply all the insurance contract with exceptions. Does not distinguish between insurance products, types, and duration. It does not distinguishes. It's generally applied to all, with some exceptions. The main principle is loss-making insurance contract. We will recognize loss immediately. Other insurance contract, we do not recognize profit immediately at the start. The next model is the simplified model. Is also called a premium allocation approach. It's for a group of contract meeting certain criteria. It's not for all no, all the contract, all the insurance contract, just like the general model. The approaches are to group of reinsurance contract held general or premium allocation approach with modification, to insurance contract with direct participation feature, just the variable fees approach, to invest contract with discretionary participation feature, modified. It's simply a modification of general model which we have discussed here. We will try to understand the general model in more detail. In general model, according to which insurance contract liability is the sum of the liability for remaining coverage and the liability for incurred claim. Just like here in this example, here when we it's 2001. Here we have started their contract, and in the mid of this 31st December 20x2, the end of the reporting date. Here in this period from 2001 to 2002, here the liability for incurred claim, we will claim this expense by the end of this. But when we look at the contract, it has a life span of till the end of 20x4. From 20x2 to 20x4, here the liability for remaining coverage is covered here through these techniques. Here it's a future one, is it's about the end of the reporting date. We will try to forecasting the future, the fulfillment cash flow related to the future service plus the contractual service margin, which we will try to calculate next in there. In our example, we have the second is the liability for incurred claim. It's the past. It's the event which has already been done. It's under our accounting period, which ended here in 2x2. The fulfillment cash flow related to the past event, past service. Next, we have measurement model, or you can say a general model, which we have discussed before in previous slide. Uh, IFRS 17 uses what is called a building block approach. First, here we will calculate the fulfillment cash flow. Second, we add a risk adjustment. Third, we determine the contractual service margin. The contractual service margin represents unearned profit, and this profit is recognized only over the coverage period, not at the initial stage. We will try to understand how to calculate CSM uh, through our examples. It will be more easy through examples. Let's try to understand this IFRS through a numerical examples. For this, here I have switched to Excel from PowerPoint. Here the question is, there is like an exam question style. Here the scenario is on 1st January 2001, an insurer issued a 1-year insurance contract. The following information is available. Premium received at inception at start, claim, expected expenses, and risk adjustment. What usually a student have to calculate in the exam is the requirement is like this: calculate fulfillment cash flow, calculate the contractual service margin, or show the initial recognition journal entry. How they pass the journal entry with what figures, and the figure it is important one here. Next, uh, although the premium received from the policyholder is 1200, uh, even though cash is received under IFRS 17, this is not income on day one. We have to remember this. Expected claims are 800, as we have seen in the question. Expected expenses are 100, and the risk adjustment is 100. When we add these together, the fulfillment cash flow are thousands, just thousands. Here, in the fulfillment cash flow, uh, these are the future obligation, the 100 expenses, 100 risk adjustment, and the 1000 which is the liability. Next, we have how to calculate the CSM and profit. It's the difference between the premium received and when we deduct the fulfillment cash flow from the premium, we get the CSM, the unearned profit. This profit exists but cannot be recognized on day one of the contract. In day one, uh, we will have the journal entry will be debit the cash by 1200, credit the insurance contract liability by 1000, and credit the contractual service margin by 200. This means that we record the journal entry, we debited cash for 1200 because money is received. We credit insurance contract liability for 1000, representing the obligation to pay future claims. We credit a contractual service margin for 200, representing deferred profit. No revenue is recognized at the inception of the contract. Next, we have the presentation of IFRS. Here in financial statement, under the asset category, we will record insurance contract assets, reinsurance contract assets. Under the liability column, we will record insurance contract liabilities, reinsurance contract liabilities, which we have performed previously in our example in Excel file. In the next statement of profit or loss, here we will record insurance revenue, insurance service expenses, which we have calculated before, insurance service results, insurance finance income expenses, net profit or losses for the period. We will record here in statement of profit or loss. For students who are preparing their exams or preparing for this IFRS, the common mistake and the risk they face were in the exam. The examiner mainly focus on the logic, not memorizing the standard. The student must be able to calculate fulfillment cash flow, explain the contractual service margin, what is it, how to calculate the service margin, show the correct timing of the profit recognition, and prepare the general uh, entry at the initial stage of the contract. Uh, when we look, when we compare this IFRS 4, why it was replaced with IFRS 17, this comparison is extremely important because IFRS 4 allowed multiple accounting models and every profit and early profit recognition. IFRS 17 introduces one global model and strictly deferred profit using the contractual service margin. This comparison is frequently tested in exam, which is also important for students who are preparing for the exam or who are uh, doing their professional degrees in standards IFRS. At the end, the quick summary and the key takeaway from this video is uh, IFRS 17 standardized insurance accounting. Every insurance contract creates a liability, a profit, and profit is deferred using contractual service margin and recognized over the coverage period of the contract. The overall purpose of IFRS 17 is faithful presentation of the company's financial statements. IFRS 17 is challenging but extremely important. If we understand the logic behind fulfillment cash flows and contractual service margin, we will be able to apply IFRS 17 confidently in the exam when we face IFRS 17 questions, and we will be able to apply in our professional practices. This is all from today's video. Thank you for watching.